Hello everybody and welcome back to another video. I'm very excited to share this video with everyone. I want to say all credit to ICT for the concepts he has taught. This is just how I internalize his teachings. So our order of operations, we're going to talk about institutional order flow, dealing ranges, reference points, macros, lower time frame entries, invalidation or stop loss placement, and a daily checklist. And we're going to see how all these things come together to form a model. So just like my previous videos, we need to understand, most importantly, what the higher time frame draw on liquidity or institutional order flow is. We need to understand if price is going to go up to buy side liquidity or down to sell side liquidity. Now, how can we get a better understanding of which direction price is likely to deliver to? We can use IPTA. Now, I'm going to do a separate video full in depth on IPTA, and if you want that, let me know. Or until then, I'll direct you to, I believe, month 5 of ICT's core content, where he discusses these things beautifully, of course. But the basis of IPTA, you would have your anchor at the start of the month after the daily market structure shift, and you would look back 20 days, 40 days, and 60 days. If we're in a buy program, for example, we want to target buy side liquidity within that 60-day look back range. So this is the same graphic as my dealing range video. And if you haven't seen that, go check that out after this video because it's super important to understand the dealing ranges. It's essential for the rest of the things I'm going to discuss. But for now, as a refresher from that video, this is the dealing range. You want to see a sell side purge and a buy side purge, and that price leg that follows it would be your dealing range. So you can identify premium of that dealing range, discount of that dealing range, and equilibrium of that dealing range. Understanding the dealing range price is operating in currently, it allows us to refine our entries until those IPTA or higher time frame targets are met. So what have we discussed already? Institutional order flow, IPTA, right? And dealing ranges. Now we need to be able to identify key reference points. What time frame do I look for with these key reference points? 1 hour or higher. What PD arrays do I use? Order blocks, breakers, fair value gaps, inversions, volume imbalances, and dealing range consequent encroachment, or 50% of whatever dealing range we're operating in. In terms of measuring these PD arrays to get the specific key reference points, we're going to look at CE, or consequent encroachment, MT, or mean threshold, or quadrants of larger gaps, and we can even look at quadrants of order blocks as well. And where do we want to look for these key reference points? When we're bullish, we want to look for reference points in discount of the dealing range. When we're bearish, we want to look for reference points in premium of the dealing range. So let's say this is our dealing range, and we've identified premium, discount, and equilibrium. What does ICT always say? We don't want to shorten a discount, and we don't want to long in a premium. So if we're bullish, we want to identify those discount KPRs when bullish. Again, you can see on the bottom left of this screen, KPR is just key reference point if you ever see it on my chart or anything. But conversely, we want to identify premium KPRs when we're bearish because we want to short in premium and long in discount. Now, all the things we've discussed thus far have been about price. What's the other side of the equation? Time. So a macro. I'm sure you guys have all heard about it before, but it's just a set of instructions told to the algorithm during a specific time period of the day. During a macro, price will deliver or spool to liquidity or inefficiency, or if it doesn't spool during that macro, it'll offer the setup that delivers us to that liquidity or inefficiency. So I'm not going to spend much time talking about the specific kill zones or macros. I just wanted to add this, so pause it and screenshot it or take notes if you'd like. So now we can see how all of these things start to come together. We have our institutional order flow, our draw on liquidity. We have our dealing range. We understand discount and premium. We have our key reference points in the respective discount of dealing range or premium of dealing range. So if we're bullish and we want to see price attack buy side, where do we want to see our entries? In discount of the dealing range off of a key reference point. But that's just the price aspect of it. We want to see that occur during a macro, during the time that we expect price to spool to liquidity or inefficiency. So we're using time and price to form a high probability setup. So this is Friday's price action. So it's fresh on everybody's mind. What do we have here? We have sell side swept. So this is the dealing range low. We have buy side swept. So this is the dealing range high. This light blue rectangle here. This is the hourly chart. This blue line up here is our higher time frame target. It's our IPTA 60-day look back for the S&P. You can see here, this was Wednesday. We fell just short of it. Now, what does that sell to traders? It sells the idea of strong resistance, that this should act as resistance and we shouldn't go back above it. But we want to target this, especially because it's the IPTA 60-day look back target. This would be equilibrium of the hourly dealing range. This would be discount, and this would be premium. So if we are to look for longs, where do the best long setups occur? In discount of the dealing range. Now, first and foremost, if we think we're going to go get this high, we wouldn't want a long here anyways because it's so far up in a premium of this dealing range. We have this fair value gap here, but the majority of it is above equilibrium. So it's still in a premium. So we want to understand what would be permissible for price to reach for in the discount of this hourly dealing range, as long as our buy side IPTA target is not met. Now, what do we have annotated? These yellow lines are a volume imbalance. You can see price to the tick came down and tapped that volume imbalance low at 45.6250. Now let's look closer. If price only goes to liquidity or inefficiency, where is the inefficiency below this volume imbalance? There is none. Where's the liquidity below this volume imbalance? It's the dealing range low. But why don't we want to see the dealing range low get swept? We're bullish. We're targeting this IPTA 60-day look back, but it's already swept this sell side here. And this volume imbalance is the only inefficiency in here. So this to the tick, is that random? No. That's the algorithm just coming back to the first inefficiency, the first key reference point in a discount of this dealing range. So we don't ditch the bullish idea just because we see this fair value gap fail, and as we're digging into this fair value gap, we don't get scared and ditch it. We're interested in the discount key reference points, not the premium key reference points, right? There's no inefficiency in this area. And we've also had sell side delivery and buy side. So this should be balanced in and of itself. So all we're doing is identifying the key reference points within discount of this dealing range on the hourly chart. Now we're down to the 1 minute chart on that same price action, that same hourly dealing range, and we're going to walk through this. So starting over here on the left, we get that first footprint, that first algorithmic signature where we touched precisely, exactly the low of that hourly volume imbalance. That's this yellow line. Look at the annotations on the right. We touched to the tick that volume imbalance low. That's the first sign that we're seeing a key reference point support price. Now, what time is this occurring? Right at 9:30 open. Does that mean we just ditch the trade and that we miss it if we're waiting for, 10 to 11 a.m. silver bullet? No. If we get an entry, a long entry that makes sense, we can take it as long as this IPTA 60-day look-back target has not been met. After we see this get taken, we're under the assumption that what? We don't want to see this get purged because it's already dug down to equilibrium of the hourly dealing range. It's already tapped that key reference point from the hourly. We don't want to see this get taken. This should be all done with per se, and it shouldn't get delivered lower. So how are we going to internalize the rest of the session? Well, we have the 950 to 1010 macro. What do we expect that to do? Spool to liquidity or inefficiency. What does it do? We get an inefficiency here that sends us down, attacking some of this sell side. But again, we don't want to see this get purged. And where does it go? Does it go to some random level? No. Look on the right. This is just CE or equilibrium of that hourly dealing range. It's sending us down from the macro, from the time where we expect price to spool, to sweep some of these sell stops and to price to equilibrium of that hourly dealing range. So as we're entering the 1050 to 1110 macro, how would I internalize it? What would I be saying? We still haven't swept this. That's what we want to see, best case scenario, until we go and get this target up here, the IPTA 60-day look-back target. So what do I want to look at? The previous macro function, those things we just described. It was just sending us down from that macro, that time period, to sweep some of the sell side and to get back to equilibrium of that hourly dealing range. We come back up, and what time do we get our setup? At some random time? No, between the 10:50 and 11:10 macro. We tap to the tick again. Precision, equilibrium of the hourly dealing range. Okay? That shows us that the algorithm is still very efficiently respecting these key reference points. This is a key reference point as well. So we've had the volume imbalance delivery, and now we're having the dealing range equilibrium delivery. What happens right after we touch this? We get aggressive buy side, close above this inversion, and what occurs in here? Well, these are those algorithmic signatures. Where are the bodies closing in this inversion? Some random level? No, it's closing at consequent encroachment of this inversion during the macro after a key reference point has been delivered to. So we could put what? Our stop loss below here, understanding that this has been delivered to, this has been delivered to. We've already disrespected this premium PD array, we'll call it, or a bearish PD array, right? If we were bearish, this should have acted as resistance and pushed us lower. The fact that we zoomed above here and closed above it is that final confirmation that you would want to see to confirm we're going to go attack buy side. So we're seeing all of these footprints from the algorithm off of the key reference points from the dealing range during the time that we would expect and want to see our setup form. Now look within this blue circle I have on the screen now. We did basically the same thing that we did here. Why didn't we spool there? Because it wasn't during the macro. So if you think about the macro function, again, we expect delivery to liquidity pool or inefficiency during this macro window. If the algorithm's operating efficiently, this is when we want to see price give us the setup or begin to spool to our targets. Now let's think about that using reverse logic. If that's what we want to see during a macro, do we want to see price spool before a macro? No, we don't want to see price spool before a macro because we want to see the inception of the move during the macro. So time distortion or consolidation, accumulation, chop, whatever you want to call it, it's more likely before a macro because price hasn't reached the time period where it's going to be told to go spool towards that liquidity. So that's why we need time and price, right? We're delivering here to this same key reference point, but it's not during the time window, the macro, that we want to see that occur. So this is my daily checklist and what I look for every day when I sit down at the charts in the morning. First, I want to identify the draw on liquidity. Second, I want to identify the dealing range that price is operating within. Third, I want to identify the key reference points within that dealing range that price is operating in. Fourth, I want to identify an invalidation point. So from the previous example, my invalidation point would have just been if we got below that swing low that delivered to the hourly volume imbalance. And lastly, that's when we look for lower time frame entries during the macro kill zone once those key reference point get delivered to. So thank you for watching as always. I would appreciate a like and a subscribe. You can follow me on Twitter as well, @RealTraderTim. And I have some sessions open for one-on-one coaching. That link will be in the description as well. You can book a session there and we can talk about more of my model. You can see more of these trades, but be sure to join Discord as well. That's free. It's in the description as well. I thank you guys for watching this video, and I will talk to everyone soon.